Unexpectedly high medical bills can throw a wrench into any financial plan. Failing to understand the tax implications of out-of-pocket medical expenses can add more stress than is necessary. Today we want to unpack tax deductions for medical care.
So Spencer, out-of-pocket medical expenses, something that comes up really frequently, especially as clients age. The reality is we have to pay for medical care throughout lifetime, but especially as we age, those expenses may increase. Now, sometimes clients come to us and say, hey, can I deduct this from my tax bill? And the answer is yes, but with some caveats. So let's dive into those a little bit. What are some of those caveats that we need to understand before we even start to deduct medical expenses?
Well, in 2025, we've got a standard deduction that for individual filers is $15,000. For married filing joint is $30,000, and then we've got $2,000 basically per person if you're age 65 or older. So we've got a significant standard deduction that we need to go above and beyond to be able to get any benefit, to itemize. You know, if we only have $25,000 of expenses and we're married filing joint, we can make sure that we have all of the receipts, all the bills, all those kinds of things, but it's still not going to help us because the standard deduction is higher. So that's, I think, the first thing that we need to recognize. The second thing is we don't get to deduct dollar for dollar our medical expenses. So it's only those expenses that are above 7.5% of your adjusted gross income that you can add to deductions. So if we think about this, you know, let's just say you have Social Security, you have pension income, you have some IRA withdrawals, and those amount to $100,000 in a particular year. Well, 7.5% of that is $7,500. Right. So if you have $7,000 of medical expenses, you can't deduct any of your medical expenses. It's only when you get above and beyond that. So we have to bear that in mind. That also has a more significant impact for folks that maybe they have a much higher level of income. So let's just say they have a pension that's really robust from Oak Ridge National Lab, and it's a couple $100,000. And then with other income, they might have, you know, $400,000 of income in a given year. Well, in that case, then they've got to get above $30,000 of medical expenses to get above that 7.5% threshold. So you got to be really careful before we start to assume that being able to deduct or itemize deductions for medical expenses really makes sense in a person's case. Right.
Well, even if we take that first example, you've got $100,000 of income. Even if you have $20,000 of medical expenses, that first $7,500, even though you cross the threshold, doesn't count. Right. It's the next $12,500. Anything on top of that, 7.5%. So that really that hurdle is it's just that. It's the first hurdle that you have to cross before even thinking about medical expenses and deductibility there. So let's presume that a client is able to deduct medical expenses. They've got itemization, they've got maybe additional state and local taxes, charitable gifts, mortgage interest, some of these other things that are other itemized deductions that gets them above that standard deduction, that $15,000 or $30,000 for married filing joint. What qualifies as a deductible medical expense?
Well, the IRS, of course, notes that there are deductible medical expenses. Generally speaking, it's things that you would expect. It's doctor's visits, surgeries, hospital stays, prescription medications, dental care, eye care, hearing aids, medical equipment, all these kinds of different things. Now, the caveat is that there's other elements that are not included. So those cosmetic procedures that you've been thinking about having, not going to help you on your tax bill.
My hair transplant is not going to come.
Well, you know, under current tax law, maybe we can pull some strings there in the next legislative element there. But no, also over-the-counter drugs, they're not going to be included there. Now, those tend to be pretty inexpensive, and so most folks are not tracking, you know, that expense. But there are elements there that we need to recognize are not going to be deductible for whatever reason.
Okay. So we've talked about medical expenses, those direct medical expenses. What about long-term care cost?
Long-term care costs are interesting because they can add a tremendous amount of both cost and they can be itemized in some circumstances. So as we think about long-term care, it needs to be medically required to count towards that expense. So let's say on the one side of things, we have a client who is not at a point where she's any longer wanting to cook food, a couple of days a week, and wants to have someone come in, be able to help assist her a couple days a week to be able to do meals and those kinds of things. Technically, some folks would think, okay, well, that's some long-term care because they're not able to do all of the different things that maybe they've done in life. Or maybe that person would think about moving to assisted living, where there's some services, there's some support that's offered. But in neither one of those cases, would it be called medically necessary?
Right.
So for anything that is not medically necessary, you're not going to be able to itemize that. But if we change the situation and now we say, okay, this person who's at home, they have cognitive impairment, or they have 2 of 6 activities of daily living, ADLs, that they're not able to do anymore, then the level of care needs to be increased typically, and it's usually medically necessary. It's recognized by a physician that, okay, this person needs this long-term care. It has to be provided, and it can also be itemized in that type of circumstance.
Okay, so Spencer, let's say we do have a client that goes into a nursing home then. Is all of that cost deductible? Because that cost may be $85, $90, $95, $100,000.
And it's a great question. And some of this is determined by actually the record keeping of the particular institution of where the client goes. Again, a nursing home to some folks might just mean, okay, I'm moving to a facility and there's some set of services there. If it's more assisted living, where the services are mainly helping to maybe clean up a client's apartment, or cook the food, or do different things like this, sometimes there would be no deductibility in that. You couldn't itemize any of those expenses. On the flip side of things, let's just say that the nursing home care is necessary because the client needs around-the-clock medical attention, and it might be $10,000 a month there. In some circumstances, all or virtually all of that expense would be recognized as something that could be itemized. So every institution is going to break out their billing in a little bit different way. You can talk with them. You can talk with your CPA to make sure that you get things right as you itemize there. But this does introduce an opportunity sometimes, if we kind of look at the different ways that these services can be paid for. Another thing that we have to recognize too is if you have long-term care insurance and it's paying for this, then that's not deductible. It's only the out-of-pocket element that you have that you can deduct. So, but there is a tax planning opportunity here, because you can imagine, okay, if we have $100,000 worth of expenses, but let's just say virtually all of them are things that we could itemize here. Well, if we need to free up resources and we have an opportunity to look at it, an IRA distribution versus a non-qualified distribution, and we're thinking about how to provide the most resources both for the client and the client's heirs, oftentimes we'd say, well, it might be time to pull from the IRA to have that as ordinary income there, but also to be able to deduct against that ordinary income so that the heirs maybe get more of the non-qualified resources there. Otherwise, if we use the $100,000, let's just say from a non-qualified distribution, there might be very little capital gain or interest income or other things that we could use the itemized deductions against there. So there's some opportunity here if we have really high long-term care costs that we want to look, where do distributions come to be able to meet those needs?
Yeah, that's really good. That's really important. So let's talk about premiums for health insurance, long-term care insurance. What do we need to know about the deductibility of those premiums?
Well, we want to first remind everyone that if you're a business owner, if you're doing some consulting in retirement, those the premiums for medical insurance can actually be you can have those included in your business tax filing in such a way that basically the business is picking up the expense of the medical insurance, and that can include Part B and Part D of Medicare, including I believe supplement there. So all of those different pieces in terms of the insurance premiums. If you're a business owner, we can run through the business there. So just one piece. Now, when we think about long-term care premiums and whether we can deduct those, you can deduct them up to a certain amount based on your age, and that changes a little bit every year. It gets, the maximum amount increases a bit every year. So let's just say you're looking at it, you have, if you're age 40 or under, you can deduct about $500 of the premium, up to $500. If you're over age 70, then that amount jumps to north of $6,000 on an annual basis. So there is a significant amount that you can deduct if you're paying long-term care insurance premiums. And you want to be aware of that, because that's, again, if you're already going to itemize, then you can add that to your itemization.
Right. So why would they allow insurance premiums to be deducted?
Well, I think it's self-serving for the US government. Basically, if you have insurance, you're going to be less likely to be living off of government funds. Mm-hmm. So you pay for the insurance, they give you a little bit of tax benefit for the premiums, but it also means that you're probably not going to end up in a state-sponsored facility with the state paying for your long-term care costs. Instead, because you've paid for the insurance will be paying for that cost, at least for a number of years.
Right, that makes sense. Okay, so let's talk about some strategies to maximize medical deductions. Like we talked about at the beginning of the episode, if you don't itemize, let's say you don't cross that $15,000 threshold or the $30,000 threshold for married filing joint, then you're not going to be able to itemize these deductions. But there are ways that we can maybe cross those thresholds if we clump and bunch. So talk us through maybe some of the strategies for how can we maximize these medical deductions?
Well, just like clumping and bunching, you could say, okay, if I've already had one procedure in a particular year, maybe if I have the option of having a procedure done in December or January, maybe I choose to do it in December if I'm trying to clump them together, or wait until the next year if I know I have a number of procedures. Now that would be also true of just looking at the deductible for the health insurance. So it may be that we say, okay, well, I want to be able to clump them together so that I have less cost of the medical services to begin with. Our family has spent a lot of money on healthcare this year, and I, have got to get my first colonoscopy this year. So good times. So I've decided that I'm going to get one done prior to the end of the year. I could wait, for a year or more, but you might as well do it when it's going to be free to you, because you've already spent so much money on healthcare costs to begin with. Right. And it's kind of the same kind of thing. If we've already got a lot of costs and we can get above that 7.5%, and perhaps it's not even going to be covered by, Medicare or something like that, then that might influence us in that direction to clump things together.
Right. So what about some mistakes that we want to avoid? One that we want to always come up with anything in terms of taxation is forgetting to keep records. So make sure that you keep good records. And this is everything from what you spent, what your adjusted gross income is, as well as maybe some of the mileage that you drove. Because you can reimburse mileage. It's 21 cents as of 2024. The numbers for 2025 haven't been released as of our recording, but the reality is you can reimburse your mileage. What are some of the other common mistakes that we want to avoid?
I'm not sure that there's a whole lot else I would say. We want to make sure that we are doing this in the concert of a plan. We're itemizing as we can, and that we keep track of everything that's there.
Great. Well, clients, if you have questions about itemizing medical expenses, please reach out to us. We would love to have that conversation with you. As always, leave comments down below, and we'll see you again next time. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.